Normally, following each budget, either Tim or I will be popping down to the Hampshire County Cricket Club to let all of the Rothmans clients know about what was in the budget and why it really matters. We're a couple of months on from the summer budget now, and we've had time to have a look, not just at the rules that most people are fairly familiar with by now, but have a look at what it really means. And there are 7 or 8 things, I think, Tim, that we really need to have a look at. The first one is a change to goodwill and purchase goodwill. We used to have rules that we thought were fairly straightforward. We could claim amortisation. No longer anywhere near as simple.
Yes, and it's a slightly surprising move given the history of this. We need to go back to 2002 when the intangibles regime was introduced. Now, from 2002, in an attempt to bring the tax system more in line with accounting practice, it was decided that amortisation on intangibles would be allowed in almost all circumstances. Only, I should say, for companies, and this change today only applies to companies. Unincorporated businesses are not affected by it. Now, under the intangibles regime, although in most instances amortisation would be allowed and an eventual profit or loss on disposal of intangibles would be a trading profit or loss for a trading company, there were nevertheless anti-avoidance rules, and the most well known to our viewers was the one that applied on incorporation. And where goodwill was transferred to a limited company that was connected with the transferors, then if that goodwill itself had come into existence before April 2002, the company acquiring it post 31st of March 2002 could not claim tax relief on amortisation. If you like, the old capital regime applied instead of the new income regime. That, however, didn't apply if the goodwill came into existence on or after the 1st of April 2002. And so this time last year, the advice that you and I would be giving in the lecture room was that if a business that was set up in, let's say, 2005, incorporated in, let's say, 2015, 10 years later, then although it was a transfer to connected persons, the company taking over the goodwill was entitled to tax relief on the amortisation.
Or so we thought until December 2014.
Well, that applied, and this is why it took us back to, let's say, summer last year. That applied until December last year, and it was announced in the December statement that from December 2014, the rules would be tightened up for acquisitions of intangibles from connected persons. And essentially, as far as you and I are concerned, what that meant was that the incorporation benefit for post-April 02 businesses incorporating post-April 02 no longer applied. They would not be allowed amortisation relief. But until 8th of July this year, the restriction would only apply if we were looking at acquisitions from connected persons. Now, what the Chancellor announced on 8th of July was far more wide-ranging, and for any acquisitions of goodwill and other, not all other intangible assets, but customer-related intangibles, on or after 8th of July 15, the acquiring company will not be eligible for tax relief on the amortisation.
So I set up a business post-April 02.
Yep.
I incorporate before December 2014.
Good.
Then I can claim amortisation.
Correct. And the Finance Act that will become the Finance Act 2015, is it number 2, 1560, whatever we call it, doesn't change that.
Okay. But if I set up a business after April 02 but incorporated after December 14, then I would not get amortisation.
Correct.
If I set up a business after April 02 and sell that business before July 2015, the purchaser would be able to claim amortisation on the goodwill it's purchased.
Yeah.
But if I have set up my business and sell that after 8th July 15, the purchaser would not be able to get amortisation.
Correct.
Absolutely essential that we watch for the dates and dot the I's and cross the T's.
Well, there'll be cases in the future, and we've already had cases where companies post-incorporation have claimed amortisation of corporation tax when they shouldn't have done, which indicates that companies and maybe 1 or 2 advisors were not familiar enough with the rules before last December, let alone since December and now since July. Yeah. So we need to take care.
Okay, so we've had confirmed the annual investment allowance, a permanent annual investment allowance of £200,000. The way they've explained this is guaranteed to confuse. They are delighted to announce the increase of the annual investment allowance to £200,000 as it falls from 500. Well, of course, that's because it was going to go back to 25, so it's a fairly dramatic increase to 200. As far as I can see, this idea of it being permanent implies that there may be extra bits in the future, but it won't go below that. So I wouldn't be surprised in future budgets to hear him say, you know, it'll never fall below 200, but this year we can have 300, or this year we can have another 500. That, I think, remains possible. We have to be careful of the cut-off again, don't we? A December change, and therefore if you've got a March year end, you need to do the maths, and certain parts of the year simply don't work very well for you. Employer's allowance for national insurance, a very generous thing, £2,000 a year. I thought if anything was going to happen, it would disappear. But in fact, we've been told it will increase.
Yes, this was quite a surprise in the budget, and I don't think any of us saw this one coming. Indeed, a lot of advisors were a bit surprised that the 2,000 continued beyond last year into this year, but it was always intended to continue. Although there is very, very good news in that increase to 3,000, there is a sting in the tail, and at the same time as increasing it with effect from April next year, the Chancellor has announced that one-man band companies, as it were, or more specifically companies with a sole director and no other employees, won't qualify for any employment allowance at all. And this is clearly an anti-avoidance measure, because without that measure there would be a greater incentive for a sole trader to incorporate and simply have him or herself as the sole director employee of the company, and they could then take directors' fees up to, I've not done the figures, but it'll be of the order of 30,000 a year without any secondary national insurance liability at all. And the Chancellor clearly doesn't want that to happen. Now, against that, there is a clear advisory point, which is to make sure that wherever appropriate, a company does have more than one director employee. And I'm sure many advisors will now be looking at their one-man company clients and thinking, well, is there somebody else, possibly a spouse, that we could appoint to the board or have as an employee? But we must counsel caution, because in, I think, NICA 2014, that's the National Insurance Contributions Act 2014, which introduced the employment allowance, there is a catch-all anti-avoidance measure which denies the employment allowance if it is being claimed as part of some sort of avoidance idea. And it could well be that the revenue will look very askance at one-man companies that suddenly become two-man or one woman, one man, whatever, in order to claim that 3,000 allowance.
And it is worth noting that an awful lot of sole trader directors, if you like, simply won't have a problem with this, because of course a lot of them earn £10,000 a year or £8,000 a year as their salary, which means they have no employer's national insurance liability anyway to create the use for the £3,000.
Yes, the standard withdrawal of profit advice would be, if you're a single person company, to take a salary director's fees of about 8,000 a year. That's up to the primary threshold, so that you're not triggering any primary or secondary class one, and then the rest of it take as dividends. But then with the introduction of the employment allowance, there was a suggestion that the director's fees should be about the same as the personal allowance, so heading towards 11,000. And although that would trigger some primary class one, it wouldn't incur any secondary cost because of the employment allowance. Well, that is still valid unless we're looking at a one-man company, in which case it won't be. Mind you, this is from next year. So we will need to review all of that alongside, of course, something we'll talk about in a few minutes, which is the new dividend tax allowance.
Well, let's talk about it now. Gordon Brown, in one of whichever political background you are from, an extraordinarily clever thing he did. When told he couldn't have a 0% tax rate, he invented one by creating the tax credit of 10%, where we add it and take it away again. That is to go, but the new tax rates will be introduced for dividends, 7.5% and 32.5%, being the ones that sit in the most common bandings, and then a 38.1% tax rate for dividends with no credit attached to it, which is effectively a 7.5% increase across the board on dividend taxation. Now, across the summer, the debate on this has been heated, to say the least. This is an evil assault. This is terrible for all people who own their own company. I tweeted and got some very favourable responses to my comment, which was simply this. £40,000 a year that you're taking out of your business, the increase is from no tax whatsoever. If you're taking it as very low salary, mainly dividend, £40,000 a year, you go from nothing at all to £1,800 of tax. Hardly a vicious tax rate. What are your thoughts?
Well, my thoughts are quite right too, and the way in which some have been advised to structure their income through a limited company to avoid personal tax and national insurance has frankly got out of hand. And although it's not what you might expect a Tory Chancellor to do, I think Osborne is quite right in bringing in this significant change to dividend taxation. And it does significantly affect the whole owner-managed business model and will make it far harder for those individuals that have been sheltering, in some cases significantly more income than 40,000 a year through a limited company and eventually taking dividends, from getting full advantage. But it could be the thin end of the wedge, and those of us with a long enough memory will remember that for that type of income it used not to be a 7.5% surcharge, it was a 15% investment income surcharge on top of the ordinary rates that applied. So I think dividends are still taxed in a very tax efficient way, although what we need to do is get our heads around the figures and advise clients on what the optimum dividend versus salary strategy is for the future.
And I think you said earlier on that this moves the goalposts, if you like, on the decision about incorporation and what have you. I don't think it does. I think it is just that there will be additional tax to pay for those people if they are going to continue to take dividends. Question, should we take salary instead? Should we take a bonus? No, we should still take the dividend, because actually, as you say, £5,000 free, followed by 7.5, followed by 32.5, is still considerably better than 20% plus national insurance, 40% plus national insurance, or 45 plus national insurance. So the answer is that we plod along, I think, with low salary, high dividend. The £5,000 number is familiar to us because, of course, as well as a £5,000 dividend entitlement at 0% tax, if you like, we also potentially have £5,000 of savings at 0%. Worth remembering that the £5,000 savings only applies if your savings income sits within that first band after personal allowance. So you have £11,000 personal allowance, £5,000 of savings potentially. If your earnings take you through 16,000, you have nothing available on the savings. That doesn't apply for the dividends.
That's right, and there was a bit of confusion initially after the 8th of July budget, but I think the fog has cleared, and the Revenue have now published a fact sheet giving various examples, and they make it clear that next year when it comes in, the 5,000 allowance will operate for dividends in a very different way from the way it operates for savings income. The latter being, as you've described, but for dividends, it doesn't depend on the hierarchy of allocating allowances and rate bands to different types of income. The first 5,000 of dividends will be tax-free, and then any excess of that will be taxed at the appropriate rate depending on which band they fall into.
And worth just reinforcing that it is the first £5,000. So if you're in a position where you had total dividend income that took you £5,000 into the higher rate, you couldn't say, oh, well, I'll set that 5,000 against the 32.5 and have the whole lot at the 7.5. It would be some at 0, then some at 7.5, then the last 5,000.
It's 0 within the rates that would otherwise apply.
Exactly.
So that's one way of looking at it, which is a computational complication. The software will sort it out, but yeah, that's exactly it.
But the summary is, if you were on low salary, high dividend, the answer is you probably keep going with that.
Probably. I think the point on incorporation, it's all a combination of things like the employment allowance, the national insurance changes, against which we have to balance the compliance costs of incorporating. And it tips the balance a little bit, but not as much as I think some had initially thought. But it's all part of a general attack on tax-advantaged incorporation, which goes back to the December budget last year with the change to the tax treatment of goodwill.
Absolutely. If we move away from business taxation towards personal tax, we've already done that with dividends, I guess. Buy-to-let was something that I highlighted in the run-up to this budget speech as something that could well be challenged in terms of mortgage interest. Many years ago we had MIRAS, which people of my age find extraordinary, that people got interest relief, tax relief on their mortgage interest. But of course, if you are a landlord, you do get tax relief on your mortgage interest as a deduction under what we used to call Schedule A. However, that is going to change over the next few years.
It is, and there's been a lot of adverse press on this particular change in the money pages of the broadsheets as well as the tabloids, because some buy-to-let landlords are going to be significantly disadvantaged by this. And an example, you might buy a property for, say, 300,000, have an 80% mortgage on it, that's 240,000 a mortgage. The interest on the mortgage, let's say for simplicity of figures, it's 5%, so 12,000 a year. Well, you may only be generating rental income of a similar amount, 12,000 a year on a £300,000 property. Currently, you would be paying no tax. Well, when the change is fully implemented and it's being phased in gradually over a period, not starting until April 17, so let's not get too overexcited just yet, but when it's fully implemented, you'll get no relief at all on that £12,000 interest, and that will mean that you'll be paying tax on the full rental, there's other expenses of course, but without any deduction for interest. It might make the buy-to-let business model simply uneconomical, and I think that's the government's intention.
And of course, a lot of people, having taken perfectly good advice over the years, have made sure that their own personal property mortgage was as low as possible, and you max out the buy-to-let mortgage because you're going to get this tax relief on it. If you also have good income from elsewhere, then the fact that you will get 20% credit against the mortgage interest is not very exciting. If you've got 45% income, now not on your net profit from rental income, but the full rental income that you're receiving.
Exactly.
Yeah, it's a very, very aggressive thing. If you do the maths on this, you can easily end up with people moving to what is effectively in excess of 100% tax on the net profit, if you like, that we used to have. So
of course, all of this begs the question as to why you would want to spend 300,000 to buy a property to generate 12,000 a year income if the interest that you're paying to do that is itself 12,000. So you're actually making neither profit nor loss. You will in due course eventually be paying tax on the 12,000, so it's even worse. But why would you do that? Answer: capital growth. And maybe part of this is to take some of that capital growth drive out of the property market by restricting the relief for the buy-to-let landlord.
As I say, it's very clever because it does both things that people are looking for. One is capital growth, and secondly is to create a way of getting tax relief on their own personal mortgage, which if you push all your mortgage into the other house, you can achieve. It does both those things. We can't criticise it if we were the writers of legislation, but if I was a buy-to-let landlord, I've had better days.
But you do have time to think about it, decide what to do with your portfolio and so on.
One of the promises that Mr. Osborne has given since 2010, really, was that when he was a pure Conservative Chancellor, he would introduce a £1 million inheritance tax threshold. And he sort of has, but at the same time, I think a lot of people will say, do you know what, he hasn't done very much at all to inheritance tax.
No. What the Chancellor has confirmed is that there will be, in due course, and it's coming in gradually over a number of years, but there will be an additional residential inheritance tax allowance of up to £175,000 per person. That figure of 175, if you double it, gives you 350, and if you add that to twice the nil rate band of 325,650, you come to the magic 1 million. Now, that would apply for a married couple or registered civil partnership, where each of them gets the full nil rate band and the new residential allowance in full. Yes, he can say £1 million is the tax-free allowance for inheritance tax. However, the new 175,000 element of that is highly restricted. It will only apply where a residence is transferred to your direct descendants And if you don't have any direct descendants, or if you transfer the residence to somebody else, then that 175,000 will not be available. And it won't be available on other assets. And it does seem extremely unfair to give this sort of relief in such limited circumstances. But be that as it may, that's what the Chancellor has done.
So can we just make sure we've explained this properly then? So if you are a single person, your entitlement is £325,000, plus if you have a house which you live in and you leave to your children or your adopted children or foster children, I think, or stepchildren, they would be entitled to the £175,000 allowance, giving you £500,000.
Exactly.
If you had the same person who left that house to a trust or to somebody else, a friend perhaps, they would only be entitled to 325.
Yep.
If you had a married person who had inherited everything from their now deceased husband,
including the house,
then they are entitled to either £1 million if they leave it to their children, or 650 if it's left to somebody else.
Yeah.
Very complicated. To say that he's introduced £1 million is massively overstating it. And something else that wasn't really picked up on the day, but I'd like to highlight, in 2018 we were promised that the 325 would start to increase with inflation again. And that has now been changed to 2021.
Yeah.
So as well as increasing it, which we've decided he hasn't really increased it, actually it's staying as it is for longer.
Bit of fiscal drag. One other point that we should make is that the 175,000 allowance will be withdrawn for properties of 2 million plus on a £1 for every £2 excess basis. And that would mean that any property worth over 2.35 million, 350,000 being twice that 175, wouldn't enjoy this new residential allowance from inheritance tax. That leads to interesting planning, and wealthier clients will need advice, first in terms of will drafting. For example, if on the first death of a spouse, a half share is left into trust rather than direct to the surviving spouse, even at lower levels, that could result in a loss of the 175,000 allowance. But in other cases, suppose you've got a property worth 3 million, well, you're not, as a couple, going to benefit from that 350,000, which of course is worth at 40% 140 grand. So what might you do? Well, the answer is you might grant a lease to yourselves and give the freehold reversion to your children, or is it grant a deferred lease to the children, because I think the former would be caught by the Ingram case, but if you grant a deferred lease to your children for deferring it for 20 years, then by the time of your death, that could have devalued the property, the freehold reversion, quite significantly, and if it's below the 2 million, you then get the full 175 each. So there will be quite a lot of interesting advisory work to do for those living in more valuable properties.
I was going to say, and it is worth remembering that there is uproar that inheritance tax is now affecting anything up to 8% of estates.
Yeah.
Well, that's worth remembering that 92% of estates, therefore, should ignore all of this, because, perhaps not ignore completely, but certainly we will see people saying you must rewrite your wills, you must do this work, where actually you're talking to a couple who have maybe a £200,000 house. So again, £1 million is a lot of money for an awful lot of people still, and advice might be necessary, it might not be. Your £2 for £1 idea is repeated in this finance bill, and it is repeated in pension law, because they've decided that if you earn more than £150,000 a year, your pension entitlement should not be £40,000. It should reduce from £40,000 by £1 for every £2 you earn, down to a minimum of £10,000 from next year. Sounds quite a shock to people who a couple of years ago were able to pay £250,000 into their pension. They could now be down to 10 grand a year.
I sometimes wonder or imagine that tucked away in a darkened room in Whitehall is an individual, probably a double first maths graduate from Cambridge, whose sole job is to think up ever more complicated ways of changing pension tax rules. Before the election, the advice that you and I were giving and accountants would have been giving to clients was that well-off individuals, high-income individuals, should pay the maximum contribution, let's say 40,000, the annual allowance, ignoring any brought forward figure, before the election. against the possibility of there being a change of government or post-election a further change in the law, tightening up pension contribution relief. And so there would have been some who, let's say in May 2015, paid the maximum 40,000 into their pension and would expect to get and will get full tax relief on that. Now, there have been two announcements, not just one, effectively, in the 8th of July budget. First, confirming what the Chancellor had previously trailed, which was that for those on income of over 150,000, the annual allowance of 40,000 will be tapered away on a 1-for-2 basis, and it'll be reduced to an amount equivalent to the money purchase annual allowance, which is another saga, and that amount is £10,000. So if your income is over 150, well, in the band between 150 and 210, that's a 60,000 bandwidth, 60 being double 30, which is the difference between 40 and 10. Within that band, your annual allowance reduces from 40 down to 10,000. Once you've got to income of 210,000, it can't reduce any further, so you can still put 10 grand a year into your pension tax efficiently. That's the first point. As I say, that was quite widely trailed. The other complication, this is where it gets ridiculously complicated, albeit just for this year, is that the Chancellor has decided, rightly I think, to do away with the complexity that is inherent in the current annual allowance regime, where a pension scheme has a pension input period ending other than on the 5th of April. And quite a lot of company schemes will have a period end that coincides with the company year end. So it may be, for example, that the company has a 30th of April year end, in which case the pension input period ends on the 30th of April. And under the fairly long-standing rules, at least since 2006, the annual allowance is given not for a tax year, but for a pension input period ended in the tax year. And so the 40,000 would apply in that example for the year the pension input period ended 30th of April 15. Now, the Chancellor announced in July that all pension input periods henceforth will end on the 5th of April. And as a transition, there will be a pension input period ending on the 8th of July 2015, and the next pension input period for every pension scheme will be 9th July 15 to 5th April 16. And so the mismatch and the exploitation of that mismatch of pension input period ends and tax year ends disappears next year. But it does give rise to an extraordinary opportunity, because it means that if you had a pension input period ending, let's say, 30th of April 15, you will now have not one, not two, but three pension input periods within the current tax year. And for each of those, you'll be able to pay the 40,000 annual allowance because it's given for a pension input period. And that gives a theoretical possibility of 120,000, disregarding any brought forward annual allowances that you may have. And
because you could have paid 40,000 in April.
If you took the advice that was being given before the 6th of April, you paid your 40,000 as soon as possible after the start of the new tax year, but within your current pension input period. So that could have been middle of April 15. You would have thought that was it for the year, but you're now given not one but two further pension input periods ending in the same tax year.
So if you had gone for your next period, assuming it was going to run 1st of May to 30th of April, if you'd paid that in May or June, that would have been another £40,000.
But it would have been an excess.
But actually that PIP now ends 8th of July, so you now have an opportunity between the 8th of July and 5th of April 16 to pay in another £40,000.
Yeah, realistically, you're unlikely to come across a case where it's the 120, but there will be many who paid the maximum 40, say, before 8th of July, and who can now, before 5th April 16, pay another 40 and get that additional 40,000 tax efficiently.
So the answer is there is this one-off opportunity in terms of the pension input period alignment,
yeah.
But in an ongoing position, we have to watch out for those earning over £150,000 a year because of the reduction in their pension entitlement. And of course, that could be a big problem. If you had a pension set up, you earn normally £100,000 to £150,000 a year, your financial advisor has told you try and pay 40 a year, suddenly you have a good year, we need to then go back and have a look and see whether we should have been paying that much in the first place. So some very important numbers to look at for all advisors, I think, in terms of pensions. We need to have a look at the dividends, I think, but probably not going to change our course of action. As far as buy-to-let's concerned, good luck, I think, and have a good look at that. Anything else that people need to look at before we get to April?
I think the main thing that sticks in my mind, and it was in our tax tip for the September Tax TV issue, is the annual investment allowance reducing from £500,000 to 200,000 with effect from 1st of January 16. Now, the legislation provides that in an accounting period that straddles the reduction, the total annual investment allowance for the year is limited to the time apportioned figures. If, for example, you had a 31st of March year end, then for the year that we're currently in, to 31st of March 16, you would have 9 months worth of 500,000, that's 375, plus 3 months worth of 200,000, that's another 50, so the maximum for the year is 425,000. However, there's a huge difference in the way that that can then be applied before or after 31st December 15. If the business spends on plant and machinery in the first 9 months of that period, then up to a maximum of 475 will be allowed. That's 475, which is the total for the whole year. Whereas if none of the expenditure is incurred until the final 3 months, January, February, March 16, the legislation restricts the annual investment allowance to 50,000 maximum, 3/12 to the 200. And it may or may not seem unfair, doesn't really matter, that's the law. And it does make it absolutely key to look at the timing of the expenditure. And if you're spending a significant amount on plant and machinery, the cash flow difference in the tax relief between having that spend in, say, December 15, where you might get 475,000, and having that spend in January, February, March 16, where you'd only get 50,000, that is very significant indeed. At least the good news is that we can now reckon that the 200,000 is a permanent fixture. Of course, future chancellors can do what they like, but Osborne has said it's going to be 200,000 for the indefinite future.
So some certainty, but an awful lot of uncertainty, I think. And very important to get these numbers right. A lot of changes that need to be considered in the very near future, certainly before December for the annual investment allowance, and next April as far as those other pension and dividend rules are concerned. So do have a chat with your advisor, do speak to the guys at Rothmans, and they no doubt will be able to put you in the right place.